Hello everyone, I am Roopak Priydarshi and today me and my group is going to present our AIFA term project. The topic we have selected is AI in trading and investments. So my group members are Gaurav Malakar, Mir Mohammad Wasif, Atishay Jain and Roopak Priydarshi. Introduction. Technology is playing a remarkably significant role in everyday experiences. It has revolutionized almost every aspect of people's lives, and financial trading and investing is no different. Investing in stock markets has never been this simple before. An advancement in technology is improving this is day by day. AI's goal is to simulate human intelligence so that machine learn and do problem solving as humans do with less cost and less time. Our project aims to identify AI's influences and changes it brings in trading and investment in financial markets and produce a reliable outcome for humans compared to AI or machines in trading and stock markets. The following factors are researched and analyzed. The role of AI's development in finance and finance industry, the possible changes AI can bring to investing and trading methods in financial markets, the applicability of AI and its parts and enablers in various processes are also discussed. Financial market and investing. Financial markets, one of the most intricate, are being affected by technology expansion and growth. Technology is easing humans' access to trade on stock markets in many ways. People can trade any amount of money using only a mobile phone and an application in its simplest form. There has been much progress in how trades and investments happen, but the idea behind it remains the same, meaning that markets have not ever been beaten or overtaken by any one individual sector or company. Thus, technology development and mostly artificial intelligence are effective approaches that many financial companies and experts in finance sectors focus on to benefit the most. This is the timeline of AI. Some noteworthy events were the invention of calculator by Blaise Pascal in the 17th century, the Alan Turing discovery of the Turing machine in 1950, IBM Watson's defeat the US game show in 2011, AlphaGo beating the professional Go player Lee Sedol 4-1 in 2016, and introduction of many AI courses in most of the world-renowned universities. Now I will hand over to my friend Mir Mohammad Wasif for further elaboration.
So now we're going to talk about AI-based trading. So artificial intelligence is to trading what fire was to the cavemen. That's how one industry player described the impact of a disruptive technology on a stable industry. In other words, AI is a game changer for the stock market. Today, AI is used in a vast range from marketing in digital economy to user experience enhancement and investing in various sectors. AI is also used in tax departments to turn the losses into tax deductions. And we also know that stock trading is evolving with various companies, and the trading processes with AI is getting more lenient. And also AI is used in many kinds of investments and in banking sector or stock trading. So what is stock trading? So AI stock trading uses robo advisors to analyze millions of data points and execute traders at the optimal price. AI traders also analyze forecast markets with greater accuracy and trade firms efficiently, which mitigate risks and provide higher returns. With the help of AI, portfolios could expand into a broader range such as real estate, debt investments, reputation management, biotech startups, and investing in the stock market. While humans remain a big part of the trading equation, AI plays an increasingly significant role. According to a study by UK research firm Coalition, electronic trades account for almost 45% of the revenues in cash equities trading. And while hedge funds are more reluctant when it comes to automation, many of them use AI-powered analysis to get investment ideas and build portfolios. So AI trading companies use various tools in the AI wheelhouse, machine learning and algorithmic predictions. For example, allowing brokers to customize exchanges and secure stocks. One benefit of AI stock trading is that it can be executed on ordinary networks and PCs. So now we will talk about the application of artificial intelligence in trading. So there are three main ways in AI has been applied in trading. The most important is discovering patterns in stocks, and also the prediction of trading based on sentiment or sentiment analysis. Here we will also use the topic of machine learning and the topic of speed trading. So now we will talk about one by one later. So the first one is the predictability of stock price fluctuations. So predicting the market can be one main reason that there is so much focus on the technology side, especially AI in financial institutions and hedge fund companies. So using AI, many simple and routine tasks that are more time consuming are processed, taking less time, less cost, and give the employees more time to focus on the more critical tasks and decisions. Predicting the news that affects the stock price is what mean to look for instead of predicting the price itself. So here we are using the news to predict the stock price, and also predicting the fluctuations in the market could bring considerable amount of wealth. That is one more reason to predict the stock price. So the stock market is known for being volatile, dynamic, and non-linear. Accurate stock price prediction is extremely challenging because of multiple macro and micro factors such as political, global, economic conditions, unexpected events, a company's financial performance, and so on. Now, during discovering of the patterns, we can see there are incredibly powerful computers that can crunch almost countless data points in few seconds or few minutes. It means they can also detect historical and replicating patterns of smart trading that are often hidden from human investors. AI can assess hundreds and thousands of stocks in flashes of seconds. Humans are not capable of processing that amount of data or seeing these patterns are at the same rate of technology. So this is the advancement of AI today. For example, using AI, some hedge funds, which are very popular nowadays, evaluate more than 100 million data points in the first hour when markets open. Now, one major thing is prediction of trading based on sentiment analysis. So using sentiment analysis, AI analyzes various social media platforms like Twitter, Facebook, headlines, blogs, articles, and many more data to find the direction of the stocks and performance or move of the traders. And here we can see on the left side a chart which is the trend of sentiment analysis over time, and as you can see it is increasing day by day. According to Google Trends, the word sentiment analysis has gained steady traction over the past 5 years. In trading, the sentiment is used to show whether the trade should go long or short. Sentiment analysis are often used in long stocks when there is a good or positive news about a company or bad or negative news about a company, and short stocks if there is a negative information about the company. And another thing is speed trading. So what is speed trading? So it is basically the high speed trading is a thing which is unnerving financial markets. Algorithmic trading allows financial firms to detect and utilize market movements and patterns at lightning or very fast speeds that bring huge profits. The graphs below show the difference which is collected from Nanex in trading activity in the year 2008 compared to 2011. In 2011, the activity got frantic and erratic. As you can see on the left side, the high frequency trading chart in 2008, and you can see that it is not much, but in 2011 it skyrocketed. So we can see the effect of speed trading in the area of stock market and investing industry. Now my friend Gaurav will continue.
Investing using AI-driven decision enhancement tools. In investing, AI is used to predict stock prices. Thus, algorithms are supposed to be trained in a set of historical trading data, such as 10 or 15 years of trading data. I know the first is an AI project which was created utilizing reinforced learning. This technique or the algorithm basically uses the current findings to avoid relying on prior results, which is possibility of another emerging pattern. The AI in investing predicts the price data fluctuations based on both old and current data. In the first phase, it accounts for all the given data related to stock prices. The difference achieved by using AI in trading as compared to humans is that it is not being affected by emotions but by the exact number of highs and lows of both up and down trends. On the left side, you can see a diagram which shows the AI cycle of an AI project algorithm which uses both updated market data and historical trading, which gives us a lot of benefits as compared to the traditional methods. Technical indicators and patterns. In markets, technical analysis indicators are used for spotting the change in prices regarding volume and different time frames. There are more than 100 indicators that could be found today in the market. Some indicators are used for more than other. They are different according to the market, whether it is stocks or forex or because of simplicity contrasted with complexity. The hedge fund industry manages $3.5 trillion and AI has been used in the industry, but the outcome is not that overwhelming compared to its application in the other sectors. There are different markets and a ton of data in the financial industry. At Wall Street, people worked hard to replace various tasks and with AI and AI-driven tools. The attempt is that AI brings better changes and do better than humans. The computers do about 90% of the trades in financial markets, and the human behind is hardly codes the robust algorithm. Use of constraint satisfaction problem in trading. So in this diagram I have shown how constraint satisfaction problem is used in trading these days. It's not directly related, but it is related to optimization of big data, which in turn is really helpful in the trading scenario. The rapid growth of high frequency trading in recent years have brought into light the use of big data in trading industry. The estimation of security volatility in high frequency trading remains a challenge in business analytics. However, according to some recent AI papers, a novel section volatility estimation model can be designed and implemented via a big data analytics approach. In this presentation, uh, we'll also explore another AI paper which proposes a graph-based big data optimization approach using hidden Markov models and a constraint satisfaction problem. The main role of the constraint satisfaction problem in this optimization process is reducing the size of search space. As you can see here, we have the hidden Markov model in big data optimization. So the use of HMMs in financial time series application faces a range of challenges. Researchers have been working on the main problems in connection with HMMs. Thus, many works have focused on the improvement of existing approaches to search for new solutions and predicting problems of evaluation problems. The proposed approaches aim to find solution for four problems: the choice of model topology, example the number of hidden states, observations, etc., the search for the initial parameters, the search for the model parameters, and the reduction of the search space. Despite the progress made, these works nevertheless face multiple obstacles that hamper their speed and efficiency. In the real world, a main challenge for hidden Markov model problems is the high dimensionality of their state space. The objective is to provide a solution quickly enough that the system can give a result in a reasonable time without losing its accuracy. And this is where our constraint satisfaction problem comes into picture. So here we'll explore the link between HMMs and our constraint satisfaction problems. Given their power and their excellent performance in several applications, the use of HMMs in the big data context is common. However, to obtain good results, new methods must be found to optimize these algorithms. We are particularly interested in two characteristics of HMMs: the number of states and the high number of observations. In this approach, we propose an optimization technique using meta-heuristics based on the CSP. Treating a problem as a CSP confers several important benefits. CSP resolution methods can be applied to reduce the state space of HMM, since the representation of a CSP conforms the standard HMM model, that is a set set of variables with assigned values and a set of containers. The use of CSP to reduce the number of states or observation and therefore improve the performance is justified by the power of their solver algorithms, because HMMs and CSPs can be seen and treated in the same way from a graphical point of view. Thus, the structure of the constraint graph can be used to simplify the solution process. In many cases, conferring an exponential reduction in the complexity and making it possible to improve the learning and prediction phases using HMMs. So here you can see we have a diagram representing the entire process, how big data is optimized using CSP, and that big data is in turn used in our trading models, which is of lot of help. So that's all from me. Now I like to pass over to my friend Atishay, who will continue from here.
Trading via image classification. So now we are going to talk about the role of AI in trading using image classification, or specifically graph analysis, to help traders make better decisions about whether to purchase or sell a particular investment. Many algorithms have been created to evaluate continuous financial time series data. Financial time series analysis can be thought of as a visual process. We produce large amount of financial time series visual data. It is advised to use the strength of computer vision algorithms for time series classification by first encoding the data as pictures. Trading is continuous, but we only like to take into consideration the start, max, min, and finish values per stock every day, since we employ a discrete representation of the continuous data. These values are in these values are in practice known as the OPHCL, box and whisker diagram. The data that we have got and the values that we have talked about, we visualize it using a box and whisker diagram. It is also known as the candlestick diagram, where box edges mark the open and close price, while whisker mark the low and high values. The color of each box reveals whether the open price finalized is higher or lower than the close price for the same day. For example, if open is greater than close, then the box is filled with black color. If the open is less than close, then the box is filled with white color. If a trader decides to follow the signals, they may do so at any point no earlier than the day after the opportunity signal was created. So here we can see an example. The left column shows the 1 minute continuous trading data during trading hours, while the right column details the desaturation process. So here we can see that in the first graph, the high is the maximum point, the low is the lowest value of the stock, the close is the value at the end of the day, the open is the value at the start of the day. So here the close is higher than the open, so the box is white. However, in the lower graph, the open value is higher than the close value, so the box is filled with black color. Results achieved by trading via image classification. Visual object recognition and object detection using machine learning and deep neural networks have shown great success in recent years. We focus on financial trading after noticing that human traders always execute their trade orders while observing images of financial time series on their screens. Recent studies suggest that the transformation of time series analysis to a computer vision task is beneficial for identifying trade decisions, typical for human using technical analysis. AI trading versus traditional trading methods. Traditional investors collect daily data from the news or other sources. They read charts, analyze past data, and use various kinds of strategies. In contrast, a robot analyst uses computer programs with applications that can analyze a massive amount of data, generate more objective, and recommend more stock picking than traditional or human investors. A human investor may charge or get less salary regularly, since a programmed robo analyst is expensive to build and program at the beginning. That makes the trader investment believe that AI is the future of trading. Conclusion: even though AI has been around for a long time, it is still called an emerging topic. This is due to its steady and surprising development in every industry, including finance. AI has shown major improvements in different finance processes, especially when it comes to investing and trading. Trading and investing in assets in stock market is a big part of finance. Many individuals and small or big finance companies are competing to benefit using AI in their strategies. Competency and seeing opportunity in AI have started trading hundreds of years ago. And then here comes AI, machine learning, algorithms, which are overthinking humans at some point. So here are the references that we have used to make this presentation. Thank you.